Hi, I'm Audie. Most people think trading is about how much money you have. It's not. Trading is a game of information. To survive in these markets, you have to stop trading against the big institutions and start tracking their footprints. Today, we're breaking down the ultimate Wyckoff Playbook, a masterclass in decoding institutional market mechanics. Trading is not just about having capital. It is a high-stakes game of information where you must learn to track institutional footprints to survive. Most retail traders fail because they are highly reactive, operating with limited information and falling prey to emotions like FOMO and panic. Meanwhile, well-informed large traders use their massive capital to orchestrate market moves, preying on these behavioral patterns by manufacturing false breakouts to quietly consume liquidity. To stop trading against institutions and start trading with them, you need to understand the mechanics of the smart money. The foundation of this strategy rests on three unbending laws: supply and demand, cause and effect, and effort and result. Supply and demand determine the market's direction. The market constantly seeks equilibrium. A small group of powerful buyers can easily overwhelm a large number of weak sellers. The law of cause and effect dictates the magnitude of a move, viewing a sideways range as the cause and the subsequent trend as the effect. Finally, the law of effort and result uses volume to validate price action. Harmony between the two confirms a genuine move, while divergence exposes a hidden liquidity trap. The market moves in a perpetual four-stage cycle that smart money uses to offload and acquire positions. It begins with Stage 1 accumulation, where institutions quietly absorb supply at the bottom. This leads to Stage 2 uptrend, the markup phase, where the path of least resistance is upward. Once the top is reached, Stage 3 distribution begins as smart money absorbs demand and offloads their positions to uninformed buyers. Finally, Stage 4 downtrend, or the markdown phase, occurs as the market seeks a new equilibrium at lower prices. To find institutional footprints, you must analyze the relationship between the candlestick spread and volume. When a wide price spread is backed by high volume, it represents harmony, confirming the move is genuine. Conversely, a wide price spread on low volume is a divergence trap, a fake move designed to induce retail FOMO. The most important footprint is hidden absorption, where massive institutional activity is trapped inside a narrow price range with high volume, signaling that smart money is stepping in to change the trend. Institutions cannot enter massive positions without spiking the price, so they must manufacture panic to find a counterpart for their trades. The bear trap, also known as a spring, occurs when price breaks below a known support level to trigger retail sell stops and breakout shorts. As retail traders panic sell, institutions use massive passive buy limit orders to absorb this sudden flood of sell orders. This order flow conversion through the matching engine causes price to reverse violently upward once the supply is exhausted. The market is driven by two primary engines: accumulation and distribution. During accumulation, the goal is building demand by absorbing floating supply, which culminates in a spring bear trap beneath support before a bullish breakout known as a jump across the creek. In contrast, distribution focuses on building supply by absorbing floating demand. This process typically culminates in an upthrust bull trap above resistance, resulting in a bearish breakdown referred to as a fall through the ice. A structural reversal follows 7 logical events, starting with the preliminary stop PS, where heavy volume first enters against the trend. This is followed by the climax SCBC, an exhaustion point featuring the widest candle and highest volume, and an automatic reaction AR that establishes the range boundaries. Next, a secondary test, ST, checks the climax level on lower volume before a false breakout. The spring or upthrust creates the ultimate liquidity trap. Finally, the breakout reveals true intent with high volume, followed by a confirmation LPS, where price backtests the broken boundary. The Wyckoff range is broken down into 5 distinct phases that guide you from the end of one trend to the start of the next. Phase A is about stopping the prior trend by absorbing its final momentum. Phase B builds the cause through a long, choppy zone designed to exhaust retail patience while institutions absorb supply. Phase C is the ultimate test, featuring an engineered false breakout to verify the path of least resistance. Once the test is successful, Phase D sees the trend move inside the range as momentum shifts, leading to Phase E, where the markup and confirmed macro trend begin outside the range. Phases A and B are defining moments where structural boundaries are set and patience is tested. In Phase A, you must look for the selling climax and the violent automatic reaction to define the support and resistance boundaries of your playing field. Phase B is considered the danger zone because the price action is deliberately messy and features constant minor false breakouts meant to trigger trader impatience. The golden rule is to avoid trading Phase B and instead observe from a distance while institutions do the heavy lifting of building the cause. Phase C is the most critical event because it marks the end of the cause and the beginning of the effect. During this terminal shakeout, price violently breaks support to trigger retail panic, but instead of continuing lower, it leaves a prominent lower wick and reverses immediately. This massive volume spike on the wick is the footprint of absorption, proving that smart money just swallowed all remaining retail supply in a single gulp. This shakeout confirms that the market is ready to move in the opposite direction. As the market moves into phases D and E, harmony is restored between price and volume. Phase D features the sign of strength SOS, characterized by widespread, high-volume candles pushing aggressively out of the range. This is followed by the confirmation, known as the last point of support, LPS, where price gently retests the prior resistance on narrow spreads and low volume, indicating there is no supply left to stop the move. Finally, in Phase E, the effect, or markup, begins, where impulse moves show increasing volume and pullbacks show decreasing volume. While textbook Wyckoff is often shown as flat, live market reality frequently involves sloping channels. In upsloping accumulation, bulls are already strong, meaning the Phase C spring will likely be shallow and may not even break the absolute bottom of Phase A. Conversely, in downsloping accumulation, bears appear dominant, requiring the Phase C terminal shakeout to be incredibly violent and dramatic to generate enough liquidity to reverse the downward inertia. Successful traders watch channel boundaries and sloping logic rather than just horizontal lines. There are 3 primary entry points based on your risk tolerance and the progression of the range. Entry 1 occurs in Phase C, during the test of the spring. It offers the highest reward but carries the highest risk, with a stop loss placed safely below the absolute wick low. Entry 2 is found inside Phase D, on a minor pullback after a sign of strength confirms the spring was legitimate. Entry 3 is the safest but lowest reward option, entering on the last point of support, LPS, after the macro breakout, with the goal of riding Phase E until climatic volume returns. The key to mastering this system is to trade the logic of the market rather than just memorizing shapes. Always start by looking for divergence to track effort versus result, letting volume tell the story that price might be trying to hide. Be patient and wait for the trap in Phase C. Do not front-run the move, but let the institutions reveal their hand first. Finally, follow the footprints by trading where liquidity is actively being absorbed by the smart money rather than where it is simply resting. Just remember, trading involves risk and aren't for everyone, so treat this as an educational guide for your financial journey. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.